Please subscribe to the channel, press the bell icon to be notified of the latest videos. This is Sage for Kalkine Media, and today's trending topic, we're going to look at Baidu as a long-term investment. Considering the backdrop of China's economy continuing to grow with an emerging middle class, China has been imposing regulations onto its tech sector and most recently on the education stocks. We've seen a shift in the balance of power. China is also seen recently to take a back seat to South Korea in the production and distribution of semiconductors for electrical goods and GPU processors. The Chinese little darlings of the tech world, Tencent and Baidu, faced smaller fines in the recent Chinese government crackdown, and the current curbs and regulations have stunned many investors and corporate entities who have lost their positions in almost a day. For long-term investments, Baidu, China's largest search engine and the world's second largest behind Google, still holds a strong moat with its involvement in the AI sector, which is expected to explode in market capitalization in the next 5 to 10 years to reach trillions of dollars. Baidu can also be seen to align with the Communist Party of China's 5-year plan. Firstly, let's explore the new regulations from Beijing. Under strict rulings, for-profit educators will have to change the way they conduct the operations to comply with not raising capital from the stock market or accepting overseas investments. They are not permitted to be directly acquired and are banned from teaching school curriculum classes on holidays and weekends. The market value of two of China's largest education stocks was obliterated in practically 2 days of trading on the back of the new regulations. This was New Oriental Education and Technology, as well as the TAL Education Group. The news on the education sector is causing cascades of investors to close their positions in the Chinese tech stocks deals, especially the US-listed ones, and perhaps direct their interests to the South Korean semiconductor stocks instead. The Chinese government are known for their regulatory pressure with the anti-monopoly and antitrust legislations from Beijing, previously blocking the IPO of Ant Group, Alibaba's financial arm, earlier in 2021. And after further investigations, the company was fined in April 2021 $2.8 billion. More recently, the DD Global IPO crashed after the rideshare app was removed from China's major app stores due to regulations imposed. For those looking for long-term investments, Baidu, China's largest search engine and the world's second largest behind Google, could be an option. For Baidu, being no stranger to the Chinese government's regulatory burdens, has planned a Hong Kong listing, and this way hopefully avoiding the brunt of the US tech stock sell-off. Now, Baidu prepares for more agility under stricter regulations concerning mergers and acquisitions, where anti-monopoly practices will not be encouraged. Having seemingly emerged unperforated from the crackdowns, the dip in the share price may provide a good opportunity for long-term investors. Baidu's sales are classified as online marketing sales or non-marketing sales, which includes AI products. A strong 27% growth rate was reported in the last quarter in their online marketing sales segment. Interestingly, though, a 70% reported surge from their non-marketing sales segment is good to note. The momentum has been gained from the recent surge in non-marketing sales comes from their AI offerings. It seems the company is evolving in a similar way the economy is scaling towards further automation through artificial intelligence and machine learning in a wide variety of sectors. Baidu presents strong fundamentals with their growth curve projecting increases in sales revenue to reach close to $33 billion by 2024. Let's take a closer look at their balance sheet, which shows a significant stockpile in cash and equivalents, reaching $6.34 billion, as well as a solid share in short-term investments, reaching $18.4 billion. Long-term debt does appear leaving a dent on the company's scorecard, so let's attempt to put $9.35 billion in long-term debt into perspective. It's evident that Baidu's AI advancements, coupled with China's focus on achieving technological leadership through AI-led transformation, would undoubtedly benefit companies like Baidu, as long as there are no further Chinese government regulatory measures implemented. The funding body's analysis of the future economy and Baidu's position in it being a positive one placed for significant growth must lend logic to Baidu's ability to borrow such high levels of debt, which requires an outlay of $484.5 million in interest annually. Analysts at Seeking Alpha have reportedly increased Baidu's rating to a buy status. The company is currently undervalued by about 30%, and its share price is expected to see a growth by 15% over the next 3 years at least. Thanks for joining us on The Report. If you like the information, please like, share, comment on the video below, subscribe to the YouTube channel, press the bell icon. You'll be notified of the latest videos. For more information and regular updates, head to the website kalkinemedia.com. Sage here for Kalkine Media.